In this video, we will be learning about the cost of capital. So, first of all, jumping right into the topic, we have to understand the basics of it. And first of all, we will separately understand what is capital, what is cost, and then we will summarize it together. All right. So, first of all, we will look about what is capital. Alright, see, capital is nothing but the investment which is made by a businessman into a business. So, the capital is the money which is invested. The money invested in the business or in a venture. So, this capital can be classified into two parts. See, first of all, why we need money to be invested? We have some requirements. See, if you want some money, then you have some reason. Like you have reason, you want 10 lakh rupees, you want 1 lakh rupees. Why? Because you want a phone, you want a laptop. So that is your requirement, right? That is why you want money. So the requirement of money, that is the requirement of capital, is there. But what is the reason? What is the reason that a firm, a businessman requires the capital in itself? That we have to know. So understand one thing, that the requirement is there for two things. First, working capital requirement. And then we have the fixed capital requirement. Working capital requirement is the requirement which you require to conduct your day-to-day operations, for day-to-day operation, like raw material. You produce something, you want raw material, you want labor, you want overhead. So this is the expenses which is required on a daily basis, right? So that are counted in the expenses which are required on a daily basis, that are counted under the working capital requirement. But if you talk about fixed capital requirement, these are the requirement which is this is the fund which is required for fixed asset. This is for long term, this is for short term, right? So now you know that there is requirement, but to fulfill this requirement you want money. That money is known as capital. So what are the sources of capital? How can you procure that capital? The sources of capital. Like you want an iPhone. Alright, you want 1,50,000 for it. So this is your requirement. But how will you procure this 1,50 crore rupees? You have two options. One, you can ask your father. Or second, you can borrow from someone. Alright. So this is your own money. This is your borrowed money. These are the two sources of capital. First, owner's fund, borrowed fund. Alright. So now one more thing you have to make clear, that under owner's fund the risk is less, in the borrowed fund the risk is high. I will tell you why. See, in the owner's fund there are three subcategories. First is equity, second is preference share, this is equity share capital, preference share capital, and third is retained earnings. Now understand one more thing. This equity share preference share and retained earnings are the part of owner's fund, and these have something cost, which we'll be talking about later. First, understand about borrowed fund now. Borrowed fund is of many types, but we are categorizing into two parts. That is, first is loan, and second is debentures. Now understand, these are the capital. So we have cleared this capital part. Now we have to jump on cost part. See, each of this capital, the source of capital, have its cost, right? For example, if you take a loan, then this we are talking about in the context of business. If a business takes a loan, that the loan incurs some cost, that is interest. So in the case of loan, that will be interest, or in the case of debt, it will also be interest. All right, because you have to pay interest to debenture as well. Whenever you issue debenture, you have to pay interest, right? So in the second part, you are moving on the owner's fund. Equity share, you give dividend. Preference share, you give preference dividend. And in retained earning, the cost of capital is opportunity cost. We will be talking about it later on in very brief. Now understand one more thing. See, suppose you take a loan. Loan is of 1 crore rupees. Alright, the bank charges 10% on it. Now, whatever you take the loan, you have to pay back. So tell me one thing, that you take 1 crore rupees and tomorrow you give you pay back that 1 crore rupees. So this is your cost? No, because whatever you take, you have to pay back. Whatever is your cost is something which is levied upper on this 1 crore, that is 10%. So this interest will be your cost. Alright, so this will be followed in everything. If you issue 1 crore rupees equity share capital, you give 1 lakh rupees dividend, then 1 lakh rupees dividend will be your cost, not that 1 crore rupees, because that is the amount which you have to pay. You have to pay the dividend as well, but that is not something, that is something that you pay on the above of that 1 lakh rupees or 1 crore rupees. Alright. So now we will be looking at the cost of every capital one by one, and you have to make sure one thing, that in this chapter you have to find a cost. They will give you the amount of them and you have to find the cost, you have to ascertain the cost. See how. So first of all, we will be looking at cost of debt. See, before understanding the cost of debt, first we have to know that there are two types of debentures actually. Whenever we talk about cost of debt, then it means debentures only. So there are two kinds of debentures. First is irredeemable. And second is redeemable. See, the name only suggests that irredeemable means that you don't have to pay it back. There is no redemption maturity. For example, if you issue 1 lakh rupees debentures, 1 lakh rupees debentures for 10%, then in case of irredeemable debenture, you don't have to pay this 1 lakh rupees back because there is no maturity. You have to only pay this 10%. Then this will be your cost. In this chapter, or in general sense, we call this amount as principal, and this is your interest. And see, if you are not paying this back, this will be not your cost. Whatever will be your cost is just 10% only. Now we will be diving into the topic. in case of irredeemable debenture, if you want to calculate the KD, which is the cost of debt, the formula is interest divided by net proceeds or amount receivable. It is also known as amount receivables. Now we have to understand that how we calculate both of this thing. We will be taking some of the examples to make you further clear. See, we are taking some case. We have case first. 109% debentures issued of 10 each. This is the question. We do not have any redemption value, so we do not take any redemption in this sense, because irredeemable debenture does not redeem, as they do not have any maturity. So we have taken the first case, that is 100 number of debentures are issued at 9%. This 9% is interest, right? So we know that this is the interest. So if you want to calculate KD, first you have to calculate interest. So interest is nothing. 1000 debentures of 10 each into 9%. Alright, so that will be your 90 rupees. This is your interest. What about amount received? Whatever amount you have, whatever amount you received, that is your net proceeds, 100 into 10. You divide 90 by 1000 into 100 to get it in percentage. So you got 9%. So this 9% is your cost. Why we have to ascertain this is the minimum return that you have to give, 9%, right? And we have 9% here. So this is the thing. All right. In this I have provided you. This is your cost of capital. Case second, 109% debenture of 10 each. So see, this was very easy one. No one will give you this kind of easy thing, because 9% is there and the answer will also be 9%. So what will be a deviation in it, this case will tell you. Of 100 each, but it says 2% discount. So what will you do? 100 into 10 minus 2%, or you can do like 1000 rupees into 2%. That will be 20 rupees. So amount receivable is 1000 minus 20, because you are giving 20 rupees of discount. So what you receive, only 980 rupees. Alright. But you have to make one thing clear, and I am making it there, that interest is levied always on face value. You have to make this thing ultra clear, or your practical will be wrong. Alright, what it says, let us understand in practice. See, so this is the amount which we received, and this was the face value. What was the face value? 100 into 10 was the face value. Now interest is 9%. This 9% will not be levied onto 90T, but it will be levied here on the face value. So the interest will be the same 90. Alright. So now when you will do 90 upon 980, the answer will be different from 9%, right? Because now this 20 rupees is also your cost. Because you have foregone this 20 rupees, then this 20 rupees will also be your cost. Case third. So now your cost will be more than 9%, or it is regular. See, because when you have less in denominator, your percentage will be more than 9%, obviously. Third case, 109% debentures, but now it is issued on premium. This is your premium. Now what will you do? You will calculate, I just multiplied it, 2%, that it will be 20. So your amount received is 1080 here. I am doing it directly. But in this case as well, the interest, which is 9%, will be levied on 1000 rupees, not on 1080. So your interest will be, say, 90 rupees. Now when you will do 90 upon 1080, this amount will be less than 9%. Why? Because your cost is now decreased. Your cost is now decreased. Alright. So now this was the thing. I'm removing this. You can note it first. Okay. So these were the three cases. Now we will be moving on. See, now I will tell the relationship between the KD and the tax. See, we have sales. When you deduct a variable cost from sales, you get fixed cost, contribution. Then you deduct fixed cost. What you get? You get earning before interest and taxes. Earning before interest, let me write it EBIT. This is earning before interest and taxes. Then you deduct interest. This is the payment which you do for your debt. The cost of debt. Whatever left is EBT, earning before tax. Then you deduct taxes. Whatever left is earning after tax. You deduct preference dividend from it. Why preference dividend first? Because they get preference, that is in their name. Preference dividend first. Whatever left is the remaining amount for equity shares, only that is left. Equity shareholders, you divide this amount with number of equity share, you get earning per share. Now see, this is the whole timeline, but we have to focus on this part only. Which part? This part. This is only vital for this time. So let us understand. See, I give an example that there is a company A, the company B. The company A does not took any debt. The company B took a debt on 10%. Alright, so I will tell you that how this tax will benefit. This company also earns 1000 rupees. This company also earns 1000 rupees. This is your EBIT. EBITDA or EBIT, that is the earning before interest and tax. What we deduct? Interest. But A does not have any, does not took any interest, so that will be nil. Interest, that is, suppose 100 rupees. Okay, you can take 10 rupees. Oh, 100 rupees. This is not the 10% of this 1000. This is the income. But I see that there is the B took 10,000 debt for 10% interest. So that will be your 1000. Oh, sorry, 1000 rupees interest. That will be 100. So take this for a while. All right. This is the income. This is the debt. So these both amount are different. That will be your 1000. This will be your 900 rupees. Now suppose there is the tax which is levied. Tax is suppose 10% again. I am doing it for easy calculation. That will be your 100. Okay. This will be a 90. This will come to 900. This will come to 810. Now understand one thing. Here you saved 10 rupees just by having a debt or a financial leverage. You saved 10 rupees interest. So this is the benefit, right? So this benefit is also adjusted while you calculate the cost of debt. How? So in this formula, you take interest, then you take 1, that is 100%, and you minus t. This is your tax. You divide with amount received or net proceed. One more thing, you will also get some cost like flotation cost, etc. That will be considered as discount only. So you minus with whatever you receive and then you write it here. Those were the cases. All right. So we have done this as well. So this is the only thing which you have to understand. Now we are going with the redemption part. Now understand this one. This is done. We are moving at the next part, that is redeemable. So now understand. You take principal amount, you take interest. Alright, you suppose you took 1 lakh, so suppose 100 crore debt and you have to pay 1% on it as a interest. Now understand one thing, that this 100 crore will be paid back after some time, like say 10 years after, 20 years after, but in this case not such requirement was there. Alright, so in redeemable both of the amount has to be paid back. So this is the difference. So if you want to calculate the KD, that is the cost of debt, how will you calculate? You take interest, you will get 1 minus t here as well. Then what you have to do is you take two values, for example plus redeemable value you deduct issued value or whatever was the amount at the net proceeds. Net proceeds, this one, which you calculated, this one, amount received. You divide this by n. Why n? N is the number of years. N is the number of years. What is the reason? Let me tell you. See, whatever is the difference between this part, redeemable value and net proceeds, is taken in various years, because if you issue debentures in 2022 and that is paid in 2030, then these years in between, these amount in difference will be distributed along with. So the number of years between the issued value and the redeemable value, this year will be divided. All right. Upon the redeemable value plus net proceeds divided by 2. This is the amount which is actually utilized. Alright. So this is your formula in the redeemable case. Alright. So this is it. This is the cost of debt which we have done. In next video we will be looking at the cost of preference share capital, retained earnings, and then we will also see overall cost of capital, that is WACC, that is weighted average cost of capital. One thing you have to make sure that, see, we learned one thing, that whatever you issue, the amount which is issued, that could be issued at discount or at premium or at par, but when we redeem that value or the debenture, this is up to the company. The company could pay at par, or at premium, this is up to the company at what value it redeems. But generally it is seen as the redeemable value is more than the net proceed or the amount which you actually received at your current period. But sometimes this redeemable value is less than the net proceed, so you won't have to be worried. You have to follow the question, because in that case the company saves the cost. In that case, when the redeemable value is less and net proceed is high, then your cost will be less. Alright, that means you have saved some money. So this is it. This is the video. We have done the cost of debt. In the next video we will be covering the preference share capital. One thing I have to mention, that if you understand this topic, the preference share capital will be very easy. There is nothing in it. There is absolutely same, that 1 minus t will be removed. We will be talking about later on that why it happens, and everything is same. There is something in equity share capital, that is the hardest part. We will be looking at it with ease, and then we will looking at the retained earnings. Retained earning is nothing but same as equity share capital, because whatever is forgotten or foregone by the equity shareholders is the retained earnings only. So the retained earnings is taken from the part of equity share capital only. So last we will do the overall cost of capital, that is WACC, that is easy part. So this was something which you have to understand. This is it. This is for the video. Thanks for watching.